I wonder if you really do think that you know what your business is worth. We do. We're experts at business valuation. The interesting thing about that, though, is that if I were to individually sit down with each one of you looking at this website, you probably have some thoughts about what your value is based on industry formula. What we say in our industry is that rules of thumb are rules of dumb. Most industry formulas that we've run across tend to be based on gross sale multipliers. And I always like to cite an example relative to gross sale multipliers. If you have a company doing $10 million a year but it's losing $1 million a year, would you pay 1 times annual sales? Probably not. So typically, when you're talking about business valuation, one wants to look at the earnings of the company, and not just the tax-stated earnings, but the adjusted earnings of the company. When we talk about adjusted earnings, what we mean are financial terms that you may have heard in the past, like EBITDA, earnings before interest, taxes, depreciation, and amortization. Could be something as simple as seller's discretionary cash flow, and basically all comes down to one basic number. It's the amount of free cash there is in the business, exclusive of interest expense and non-cash expenses, that are available to you, the buyer, to acquire the company, pay yourself a reasonable salary, and still have adequate working capital. Most valuation formulas are based on a multiple of this number, or as you've probably heard in the past, a multiple of EBITDA, or SDC, seller's discretionary cash. Each industry, depending on its stance in its space, will have different multiples. Right now, food and beverage is probably at an all-time low in terms of the multiple of earnings that people will pay, because the food and beverage industry has taken it on the chin due to the weak economy. Cost of goods is up considerably from where it was some time ago, and yet if the restaurant owner even dares to put a quarter more on the menu, he fears, or she fears, for the fact that they may lose customers because of it. On the other side of the coin, if you have a business that is engaged in the manufacture of medical instrumentation, the multiples are double today what they were 10 years ago. So it's important to know, not only as a certified business appraiser, as we are at George & Company, but as an individual that may be looking at a company for sale, as to where the company you're looking at and that company's industry stands in relative to supply and demand. We get 3 things that people ask us for all the time. 1 is manufacturing, 2, distribution, and the 3rd most commonly is a service industry. Each one of those will typically sell for a different multiple, and those multiples will change on a regular basis. The manufacturing facilities right now are typically feeling pretty good hit from the economy, or I should say probably a pretty bad hit from the economy over the last 6 quarters or so. And even though we're starting to see a little bit of light at the end of the tunnel, they have been relatively depressed in terms of earnings. But surprisingly, their demand remains extremely high. The demand is from strategic buyers. Strategic buyers are those folks that may have a complementary product line. They may see that you have one customer that they've been trying to get for years and years and years, and they think the acquisition of your company will add value to their company. There are job buyers that are people that are out there that might have been laid off from a major manufacturing concern and are looking to buy their own company, thinking, I don't ever want to get a pink slip again. And you also have the private equity and private investment people that are paying different multiples. So in talking about valuation issues, we have a lot of fun with business valuation. Recently I met with 2 owners of a company, and typically before we are engaged to perform a valuation of a business, I'll ask the principals what they think the value of their company was. And I had 2 very well-refined gentlemen not too long ago that I was sitting down with, and I asked them if they had a feeling as to what they thought their business was worth. And one of them just slammed his hands down on the desk and he said, absolutely. I said, really? Have you had an appraisal done? He said, no, but we know exactly what it's worth. And I said, well, what is that? He said, $2 million. I said, really? How did you come up with that number? He said, well, I want $1 million and my partner wants $1 million. Things like that happen all the time. So you have industry formulas that are driven by some crazy rule of thumb that, as I said before, could be a rule of thumb that's a rule of thumb. You have anticipated value, which is what someone thinks it's worth but may have no financial basis whatsoever. And then you have my favorite rule of thumb, which is, I'll give you $100 million for your company if you'll take $100 a day for the next 1,000,000 days. That's with no personal guarantee for me, by the way. Because if you stop and think about it, if I do a deal like that, which would be referred to as a highly leveraged deal, I have no risk. If the company's making money, I can pay a manager to run it. I can take whatever proceeds that are available to me at the end of the day, the end of the month, the end of the year, and if things don't work out, I can walk away and I haven't lost a penny. And frankly, if I'm paying someone else to run it from the proceeds of the business, I haven't lost any time either. So you almost look at business valuation from another point of view, which is what we consider to be burden of management. If you're going to invest in the stock market, and if you stop and think about it, about the only involvement you have is maybe turning on your computer a couple of times a day to see what that stock is doing. You don't have to run the company. You don't have to make the tough decisions. You don't have to wear the multiple hats that all of us business owners have to do. All you have to do is trust the people at the company to do a good job running it, to make a profit for you, and hope that the stock will go up in value. This leaves you with little, if any, burden of management. If you're buying a company, you have to not only look at what the earnings of that company are and how much money can be made, but who's going to be making that money. Are you going to be the one sitting behind a desk like this, and I wish I had the 100 hats that I wear every day, making all those tough decisions, and maybe having to stay till 8 o'clock at night, and maybe having to come in at 7 o'clock in the morning for a meeting, and maybe having to work a weekend or two every now and then to earn $100,000, $200,000 a year? Or could I put that money in the stock market and make that same kind of money? Are there different levels of risk? Of course there are. Buying an existing company makes business valuation much more interesting than a publicly traded company's valuation for a number of reasons. First of all, a publicly traded company's value is not necessarily based on its earnings. And all I have to do is ask you to go to an online site like E-Trade or any of the other online brokerage sites and look at how many companies are selling for negative earnings, or I'm sure you've heard the term price to earnings ratio or PE ratio, and the company will have no earnings, but they'll still be selling for $10, $20, $30, $50 a share. If you remember the big bubble of the IT era, all these companies that were, including Google, that were making no money, that were selling for $300, $400, $500 a share. That typically doesn't happen very often in the world of small business appraisal. Earnings are what generate value in a business. However, there are many other elements that can be involved. We like to say that every potential buyer of a business, whether it be a small Main Street business like a dry cleaner or a liquor store, all the way up to a large $50 million manufacturing firm, if you're going to buy a business and you're going to have a burden of management, that means you're actually going to be running that business. What you want to do is feel it here, here, and here. Feel it in your head, feel it in your heart, and feel it in your belly, as well as in your wallet. Because by doing that, you're going to be getting up in the morning, be more excited about going to that business, and if you're more excited about it, chances are good you're probably going to make more money doing so.